Hello and welcome to Markets Today. I'm Lata Venkatesh and joining me from the New Delhi News Centre is Surabhi Upadhyay. Not a very good day for the markets. For actually the third time this month, the markets have not been able to capitalize on good news. We saw that happen on the rate cut day. We saw that happen on the day when the insurance bill got passed. And we are seeing it again today when there were dovish cues from the US Fed and most Asian markets and Wall Street were roaring. The Indian markets failed to capitalize. Is this a trend of the times? That's what we will try to discuss later on in the show. Hi, Surabhi.
Hi, Lata. Yes, not a very great feeling as we're getting towards the end of the week. Lots to talk about over the next half an hour. Let's start with the headlines. Markets take a dramatic U-turn in the last hour of trade with the benchmarks wiping off all the morning gains to end down 0.7%. The Nifty sinks all the way to 8630. The Sensex loses 200 points. Infrastructure, real estate and capital goods stocks feel the heat.
Banks collapse in the second half of trading, leading the market fall. The Bank Nifty ends 1.7% down. Large cap names like PNB, Bank of Baroda and Axis fall over 5% from their morning highs. Mid-cap banks like Andhra Bank, Syndicate and Oriental Bank of Commerce also see some big selling pressure.
Broader markets not spared of the pain either, with the mid-cap index down 0.4%. High beta plays like GMR, Adani Power and Indiabulls Real Estate lose between 3 to 4%. The new listing of the day, Airtel Communication, has a dismal debut, falling 10% in trade.
Those are some of the headlines from the market, and here are the experts that we have lined up on the show for you today. Jitendra Sriram of HSBC India will talk about how he sees the near and the medium-term trends in equities. We will also listen in to the US Federal Reserve Chairperson Janet Yellen after her statement sparked a rally on Wall Street. We will also get you the author of The Thoughtful Investor, Basant Maheshwari, who will speak to us about his investment philosophy.
All right, before we get to all that opinion, let's talk about the day's trading highlights. Dalal Street seems to be in quite a firm bear grip. The market started the day on a stable note on the back of positive cues from the Federal Reserve meeting, but a dramatic U-turn in late trade saw the indices give up their gains. Anuj Singhal is now here with the details of the day's trading action. Markets taking a big hit in the last hour, Anuj.
Clearly, the market today, yet again, it was a disappointing session for the bulls, and the reason was that again in the morning everything looked good for the market. You know, the Fed event was out with a positive outcome. US markets were positive, Asian markets were looking good, SGX Nifty was indicating a good opening, and a good opening we had, but from there the market slipped. In fact, the Nifty lost 150 points and Bank Nifty lost 550 points from the morning highs. That was the kind of damage that the market had in the second half today. Let's talk about the stocks, and really it was all about banks again in today's trade. PNB, Bank of Baroda, Axis Bank, they were all down between 2.5% to 4%, and even the biggest ones in trade, ICICI, SBI, HDFC Bank, all of them losing anywhere between 3 to 4% from the morning highs. Apart from that, there were some other stocks that pulled down the Nifty. So stocks like Reliance, BPCL, HCL Tech, they were all lower in today's trade. On the gaining side, pharma is one sector which is still shining quite bright. Lupin was up about 2.5%, Asian Paints was up 2.5%, and GAIL was the surprise winner, up about 2%. On the mid-cap side, quite a bit of sell-off in the high beta space. Stocks like Reliance Communications, HDIL, GMR Infra, all down between 4 to 5%. Not just that, if you take a look at the top traded stocks, there was quite a bit of red. Stocks like Adani Power, Indiabulls Real Estate, and Suzlon down 3 to 4%. And the most damaging part about today's trade has been that it's the third time that the market has started with a big positive gap up after positive news flow and has ended at low point of the day. This market clearly, for the near term, is in firm control of the bears, and the Bank Nifty is leading it lower.
I completely take your point, Anuj. Thank you very much for joining us with that. And what was worrisome about the way the banks fell is they appeared to fall without enough reason. It isn't as if there was a big rise in the yields and fall in bond prices. If anything, the yield on the 10-year fell today in response to, of course, the global fall in yields led by what happened in Wall Street. Bond yields, the 10-year bond yield fell to about 7.75 from the overnight 7.79. All this should have been actually marginally positive for the banking stocks. as well. One expected some risk appetite early morning. None of this seemed to materialize at all. So one would worry that somewhere it is the India economy story that is getting questioned, and the investors are now starting to reflect it in terms of unwinding at least long trading positions, if not investment positions.
All right, on that note, let's get some market opinion going. Jitendra Sriram, MD and Head of Research at HSBC India, expects the markets to trade within a range driven largely by local cues rather than global news. Let's listen in.
There will probably be a little bit of a relief rally now in the market, given that most people are now pushing back the rate hike expectation probably to 3Q of this calendar. And our house call is also that probably you will expect the first rate action coming through only by September of this year. Having said that, I would probably say that the market might become more dependent on local news at this point of time, since this big event is out of the way. And my worry is that the April results, the earnings season, might still be a little bit lackluster as what you saw in the 3Q numbers as well. So I am expecting a much more range-bound market over the next 3 months, rather than something which is trending rapidly up or down either side. I would probably expect at least the current earnings season, i.e. the Jan through March season, and probably even the June season, to be a little bit muted before the recovery process starts kicking in. We have a calendar year-end target of 30,000 for the Sensex, which means more like a 7-8% kind of an upside from this point of time. And that's also partly because the market has done quite well in the first 3 months in terms of move up.
Well, as you can see, several experts toning down expectations in the days to come. Well, let's get back to the action of the day for all that happened in the futures and options space. Let's go across to Nigel D'Souza.
Well, looking at the derivatives market, shorting the Nifty as well as the Bank Nifty at any point of the day after 2:30 would give you big money in the final hour of trade. That's because the Nifty as well as the Bank Nifty cracked. So if you're going short on the Nifty as well as the Bank Nifty, you would have made big money. And the Nifty, in fact, did see a small open interest build up, but the Bank Nifty, the open interest build up was close to around 10%, indicating there is aggressive shorting on the Bank Nifty itself. Now, the 9,000 call has the highest open interest on the call side, so that's a firm resistance for the Nifty. No one's really talking about the Nifty going up to those levels, but the 8,800 level, that appears to be the near-term firm resistance, because the 8,700 call, that was seeing writing today. The premium over there fell from around 90 rupees all the way to around 45 rupees. So those traders, they're looking to eat into that premium of around 50 to around 100 rupees. The 8,800 call as well did see the premium fall from around that 50 rupee mark all the way to around 20 rupees, indicating that those traders as well, they're looking to eat into that premium of around 50 rupees in today's session itself. Now, low level put buying did give you big money. So today the Nifty opened gap up more than 50 points. At one point of time, the 8,600 put, the premium was even sub 20 rupees, and that premium in fact ended at around 60-63 rupees. So if you bought the 8,600 put when the Nifty was at the high point of the day, you would have made big money over there as well. The 8,400 put, that has the highest open interest on the put side, so that should be a firm base for the Nifty in the near term. Individual stocks that went focus, some of these banking stocks, they were getting sold into. So OBC, Allahabad Bank, as well as IDBI Bank, all of them were getting sold into, while HDIL did see shorting in today's session. That stock ended down by close to around 5%. Just Style, though, that was a standout performer. Big buying being seen on that counter. Open interest built up of more than 15%, while the stock was higher by close to around 8 to 9%.
All right, Nigel, what a volatile day of trade. Thank you for the details. Let's move on to some stock-specific action now. SpiceJet slumped by over 4% in trade today after the Delhi High Court has ordered aviation watchdog DGCA to deregister 6 planes that belong to the no-frills carrier. Ashmit Kumar now joins in with the details. Ashmit, run us through the details of this case and really what lies ahead for SpiceJet.
Well, from what we're picking up is that SpiceJet, under its former promoter, had experienced severe financial constraints, and because of that, we understand that various dues were not paid to various lessors. 2 amongst them, both of them Irish lessors, one Avas, the other one Wilmington, had moved to Delhi High Court alleging non-payment of dues, and as a result of non-payment of dues, they had filed an application with the DGCA seeking deregulation of 6 planes that were flying with the SpiceJet. Importantly, Delhi High Court, after taking into account the considerations of not just SpiceJet and the lessors, but also that of the regulator here, the DGCA, we understand that the Delhi High Court has given very explicit directions to the DGCA to concede to the demands of the Irish lessors and to go ahead and to deregister 6 planes of SpiceJet. Now, just to paint a picture here, just to give a broader context. SpiceJet at one point could boast of a fleet of 60 planes. As of now, we understand that the fleet, as per their own website, their fleet consists of 32 planes, and of these 32, we understand 6 will go ahead and will be deregistered. Also, another aspect to be kept in mind is that a similar application by another Irish lessor by the name of BNB is currently also pending before the Delhi High Court. So today's order could have a significant bearing on the other case as well, which incidentally is also seeking the registration of another 6 planes. So potentially 12 planes. Losing out on 12 planes is what SpiceJet is looking at. For now, confirmation as far as 6 are concerned, DGCA has been directed by the Delhi High Court to deregister these planes. Back to you.
All right, Ashmit. Well, that's pretty anxious times. 6 planes ordered to be deregistered, and perhaps another 6. Who knows which way this goes? But that's the story on SpiceJet. Lata?
Well, the stock of the day also was Wockhardt. Performed well today, hit a new 52-week high, and of course settled down, although it still remained in the green, about 1.5% higher. This after the US drug regulator said it hasn't found any issues with respect to data security and control measures at the company's Chikalthana unit. Ekta Batra is here to give us all the details of what created this big rally in Wockhardt. Ekta.
Well, Wockhardt was one of the buzzing stocks in today's trading session. It was reacting to the fact that the US FDA re-inspected their Chikalthana unit. Remember, it was a follow-on inspection by the US FDA. This is after Wockhardt did say that they have completed the good manufacturing practices remediation in October 2014. Now, in terms of the new inspection that was conducted by the US FDA, the positive was that there were no issues with regards to data security and control measures which were found at the Chikalthana facility, but the observations from the 483 were on products and manufacturing prior to execution and implementation of the GMP program. So overall, yes, it was a positive that the US FDA re-inspected their Chikalthana facility, but as per the management, they do have to reply to these observations that the US FDA made, which were fresh observations, but they related to products manufactured prior to the execution and implementation of the GMP program. So according to analysts, there is some amount of foreseeable timeline in terms of when the import alert could possibly be resolved for Wockhardt. So overall, yes, a positive that there were no data integrity issues that came out from the observations, but a complete resolution of the Chikalthana facility would possibly take some more time.
All right, Ekta, thanks so much for that. Let's now listen into what the management of the company had to say.
We recently had to our L1 Chikalthana facility US FDA inspection, which was in continuation of their last visit and observation. I think during the 10-day intensive inspection, they found our quality system and manufacturing system satisfactory. However, they wanted a proper review of the products manufactured previous to their last visit, and they have given 483 to us and number of observations.
Right, now let's move our attention to the global arena. Has the US Federal Reserve edged closer to its first rate hike since 2006? Well, in its monetary policy statement released last night, the Fed dropped the word patient, but its indications and its observations on growth indicated that, if anything, it is willing to be even more patient before it raises rates. Let's listen to the big person from there, Janet Yellen herself.
Just because we remove the word patient from the statement doesn't mean we're going to be impatient. Moreover, even after the initial increase in the target funds rate, our policy is likely to remain highly accommodative to support continued progress toward our objectives of maximum employment and 2% inflation. We consider it unlikely that economic conditions will warrant an increase in the target range at the April meeting. Such an increase could be warranted at any later meeting, depending on how the economy evolves. Let me emphasize again that today's modification of the forward guidance should not be read as indicating that the committee has decided on the timing of the initial increase in the target range for the federal funds rate. In particular, this change does not mean that an increase will necessarily occur in June, although we can't rule that out.
Okay, that was the Fed chair. Now let's get you some opinion on the Federal Reserve's decision to keep rates unchanged.
Well, I think they wanted to get away from having some word in there that gave some indication of exactly when they would move, because they really are, I think, rather uncertain about where the economy is going, and so they don't want to give a false sense of confidence that, it'll be 2 meetings from now once we remove that particular word. That's not what they want. They want the focus to be on the data. So we've kind of moved from dates to data. But I think really what they're trying to say is that, we're a little bit concerned that inflation is not moving back up and that the job market may not be as strong as we thought. So we're going to be very deliberative about before we move.
Well, I think the big issue here, which is not being talked about, is the dollar. I think the reason that the Federal Reserve is being more dovish in its forecasts and has downgraded its estimates of economic growth is because the U.S. dollar has risen by about 22% on a trade-weighted basis in the last 8 months. And that is going to hurt U.S. exports. It is going to slow the economy down. The Federal Reserve doesn't want to talk about the dollar directly. That's clearly behind their more dovish language today. I think that's really the question also for markets going forward.
Right, so that's 2 good reasons why perhaps the Federal Reserve sounded dovish. The strength of the dollar hurting exports and growth itself slowing down. Well, the dovish Fed statement did give legs to stock markets in Asia. Most markets ended higher, except the Japanese Nikkei. A stronger yen saw that index drop about 0.3%. The Shanghai Composite was marginally in the green, but the Hang Seng in Hong Kong rallied 1.5%. The South Korean Kospi gained 0.5%. Well, that's the world for you at this point in time. We'll take a break, but coming up, Sudarshan Sukhani will join in for a technical chat. We'll get you some trading ideas and, of course, more on investment philosophy.